Welcome to the Twomey Stock Market Report. It's Sunday, June 12th, 2022, and I'm James Twomey. Welcome aboard. Let's get right to it. We certainly saw Friday a major downturn in the market, something that we were somewhat predicting. We took our starter positions, the third or a quarter, Wednesday and Thursday on shorting the NASDAQ, the SPY, as well as the S&P, and as well as the diamonds or the Dow. We're going to go a little bit into that and get in the weeds on those particular trades and what to do for Monday. But before we do that, let's just take a quick update, on the Twomey investment processes. Correct. As we know, we identify the trend. We go back, 6 to 8 months, and then look at it at 3 months kind of intervals and say, where are we? Is the market up or down? But look at it much more detail or is it just going sideways? But we also look at it with a couple of other details, and that is the macroeconomics, which we're pretty well aware of, and that's we've talked about it ad nauseum. But we also look at the environmental factors. I want to touch upon that. Environmental factors, kind of things that are happening. What is the Fed doing short term? What is the policies of certain companies, banks, or government, or is there something more external that are happening? Embargoes or wars or something of that nature. So with that said, let's look at what, with this inflation coming hot last Friday, the biggest factors, it's energy, of course, food. Yes, supply chain is adding to some of this, and the full employment and the lack of trying to get people, and the fact that we've increased minimum wages and everything. The cost of doing business has gone way up. Energy really hits everything from people making products to running companies to filling up your gas tank and deciding to take a plane trip for vacation, driving, or staying home. So that environmental factor, just energy alone, which was such a huge increase and a big add or to our inflation. Just keep in mind, there's no solution on the table. It's not going to change. It's not going to change overnight. We're going to, we know energy, if we trade it, is very volatile. It can be up 10%, down to 10%. It is all over the map some days. They're releasing 1 million barrels a day or something like that from the strategic reserves. That's nothing, and they're going to do that for months. That's nothing, and it's not going to help anything, quite frankly. The war, if that stopped, would that kind of make some changes? Yeah, certainly. It helped fuel probably more the entire stock market. I don't know about energy, because we have to unwind all these Russia sanctions and a few other things. Okay. So anyways, the push to go to solar panels, wind, and electric vehicles, I'm not saying it's a good or bad idea. I'll leave that up to those people who, have skin in the game or really interested in that stuff. But I can just say from a layman, those solutions are not ready yet for prime time. And we're faced with going to $5 a gallon gasoline, and there's no alternative out there. To buy an electric vehicle is cost prohibitive. Even if it wasn't cost prohibitive, how the heck are you going to, charge it? If you live in downtown Boston, if you live in downtown Houston, or if you live in someplace that's got, in Maryland's got, multi-tenant, there's no place to plug in. You know how hard it would be to get plug-in stations on the main street of a triple-decker neighborhood in South Boston? I mean, come on. The solution is not there. So we have a long fight ahead. Also, too, what's on the heels of this, and it hasn't been said too much, is consumers. We have limited expenditure span. What do I mean by that? Eventually, they say everybody's flush with savings and people are working from home. When that's all said and done, if you look at the cost of taking a trip, a plane ride to vacation or what have you, the hotel rooms, it's astronomical. At some point, people are going to pull in their horns, and that's going to take time. But once it does, and the consumer starts spending, that's going to accelerate us into a recession. So environmentally, we're in a no solution zone right now. And I don't see that changing. So keep that in mind as you put it into our factors to how do we trade. We'll go into the sector analysis. I'm going to go into a little bit deeper on those sector analysis to give you a snapshot, especially after what happened Friday. It's very interesting. All right. As far as positions, our other long positions, we're trying to play a lot in the defensive sector. Some we kept, some we didn't, some we lightened up, some we didn't. I would just say for now, our XLU utilities, I wouldn't be ready to shed the last third until even if that, because that's one of our defensive plays. Also the healthcare sector, I probably wouldn't shed that last third on that. Some of our other stocks, you'll have to make those decisions. But the ones that are, certainly the commodity type plays are doing okay. Some of them we haven't even shed our first third. I'll do more on that next week, but I want to get into some other things on this one today. We're all familiar about how to handle our stops. The only one that sticks out in my mind is copper. Hold off on that because that bounces up and down, and I'll talk about that in our sector table. As far as playing tomorrow, Monday, here's my thought process. Usually in major market swings, volatility is heavy. Up 1,000, down 1,000, up 800, down 500, and it swings dramatically. I don't know if we're going to have a snapback rally tomorrow. My gut says no because it's summertime. There's still people on long weekends. Hedge fund and fundamental managers can go a little bit of autopilot on these weekends, and then Mondays and Fridays kind of fit that category. They put in models and they have their computers. I've said this before. They've got all their computer trading locked and loaded. So unless something really goes sideways fast, then those computer models kick in and that takes over, right? Selling or buying. But and that's really out of our control, and it's hard to predict because we don't control that part of the market. But with that said, here's my thought process right off the top of my head. If we wake up tomorrow, what I would like to see and what will happen, I don't know. But on bear markets, and when we start going down, oftentimes in the morning pre-market, there's a slight rally, or there's the indices are in green, and that kind of rallies a little bit into early morning, late morning, early afternoon, and then the market falls down and sells off. And then that repeats itself for a while, and not until at the end of the day when you see buying and major buying, then that's a different story. Then we may be seeing the reversal. So with that said, if you wake up tomorrow and you see it, the futures are up 200-300. I'd kind of see where it goes by between 11 and 12:30. You want to start adding to those short positions, especially if it's still in the green. My thought tomorrow, we may wake up and may be in the red and it may get to green, and then but either way, if we get a rally of some sorts tomorrow, either early morning or late morning, you want to start adding to your short positions. That's what I'm going to do. If I wake up and it's just down, I'm gonna hold off at least until I see a little bit of a buyback. So let's say we wake up and the futures are down 250. I'd wait, see if by 10:30, 11 they get up to even or a little bit in the green. Then I'd start shorting, adding to my shorts. Now, aggressive traders only, and you have a choice here. You can either do the 2x. 200 times, or the standard 1-for-1. I'd start shorting the small caps. our indicators have not kicked off to say do that. And let's RWM is the one-to-one shorting of the small caps. So IWM is what I use to track small caps. But with that said, as you can see, in our 120 minute, not a daily chart, 120 minute, we did have the crossover in our third indicator. The faster indicator, stochastic, is very healthy and up above 75. The MACD is positive and it has crossed positive. It's above 0. And then we got our inflection point change. It would have been better to go in, obviously, Thursday, but we didn't. But with that said, there was a big gap up because of Friday. Relative strength index on the 120 chart is showing us a 68, so it's over bought, right? So now let's look at the daily. The daily, as you can see, if our inflection point to 10 is not crossed over the 15, and I may change these to 9 and 14 because it's a lag period. We want to see the market trend develop. We're not day traders. We're not short-term traders. We want to trade a trend and make some money and have some relaxation. Hey, it's summertime, right? It's golf all the time. We don't want to be worried about our phone beeping while we're in our backswing. But with that said, we've seen this fast stochastic cross. It hasn't got up to 75, but it's near there. The MACD still below 0 in the negative territory. So it's not telling us, we really only have one of our three signals telling us. It is above the 50. This is the short side now. It is above the 50, and it's certainly above the 200. We've got a relative strength index here of 55. It's climbing. So, same strategy. If we wake up and everything's in the green first thing, you want to start adding to your shorts. And, you can, if you get up and it's 9:30 and things are, popping, the Dow's up 300 points, goes up to 350, even before 10 a.m., I'd start adding to my shorts. Nibble. Another way to look at it, if you put in a quarter or a third, we're now working on our second 1/3 add. Okay, so you don't have to buy it all in one swoop. You can add a little bit during the next couple of days. So I would do that. Just the TWM is the 200 times. That is same story. So, and if we look at IWM, which is the long position, this is our daily chart. As you can see, we're just getting to that inflection downward point of our third indicator. And what is the relative strength index? It's 42 as of Friday, close Friday. So it's not oversold and it's not overbought. What is oversold? Down in the 30, 35, 35 we start, 38, 35 we pay attention, 30 is technically the oversold. Overbought would be way up here, and it's not nowhere near overbought. So just be careful. Small caps have been resilient, but they did get a retracement back to 0.5 on Fibonacci. I would say they're ripe for a pullback. And we want to ride that down if we can. We're getting in a little bit early, so be careful on those startup positions. While we're on it, let's take a look at our S&P long, SPY, daily chart. And we just hit that inflection point on Friday. And I can expand this a little bit more, but it went down. We obviously expected that. It would drop like that. So with that said, where is it headed next? This is a good example. Friday's relative strength index, where did it close at? 38. 38.8. 35, we go, whoa. 38, we go, And then 30, it's like, oh my God, that's definitely oversold. So in a day, we went from not a bad reading to nearing oversold. And if we look at if we're a chartist, we'd look at and we say the last low was down at close of 393, but the low was boy, I can hardly read that, 86. And then, our low that we eclipsed Friday was 389. So, and the next low below that is 380. So we want to slip below this last low of 386, and we certainly want to slip below 380 if we're a bear. We want to see if we want the market to go down. So this is going to be interesting. That's why I'm thinking we're going to get a little bit of a snapback rally, and we could add to our shorts. Okay, the 120, just to kind of go over that, the relative strength index 26. So that's saying it's oversold, and that we should get a bounce. All right. That's why I'm saying we should have an opportunity to get into some add to our shorts, and then if it bounces, it's okay. It could bounce as much as 50% and go, be up 400 points tomorrow. But if that's the case, we're working off at second, third. We'll just keep adding a little bit at a time over the next couple of days. All right. And the short side of the SPY SH is relative strength index there is 60. So we certainly got a big crease. We did get the crossover as we expected. It's fast stochastic, straight up, well over 75. The MACD is I don't think it turned positive, but it's just over turning positive. And the green hasn't even crossed above the red yet. Again, the bottom is the stochastic. It's our short oscillator. If you trade it off that, you're in and out all the time. The MACD is a really good trading vehicle. When it crosses positives and negatives, the red and the green, they're good entries and exit points. But I personally don't like to trade that fast. But with that said, I'm looking at this potentially, continuing because the MACD has to start hitting positive territory and moving up. The 120 is certainly, I bet you the relative strength index there is 73. So that's all saying the short side of the SPY has been a little overbought. Okay. So if we get that pullback, it's a good time to add. So that's our story and our game plan. Want to take a quick look at copper, and then I'm gonna dive into our sectors. Copper hasn't crossed down, but it's very close to crossing down. It did take a beating Friday, like everything else, even energy. But I'm going to wait on materials just yet. Copper, part of that too, behind the scene, is the dollar has made a slight rebound. The stronger the dollar, the less interest people are in the rare materials like gold and silver, and copper is more of a production type item, but copper. So the dollar took a major rebound the last several days, and as that climbs, it makes gold less, those specialty gold, silver, and whatever, less attractive, right? It's just they're it's like the bonds, shorting the bonds and going long on bonds. It's the same kind of the inverse is always sometimes a better play. In other words, short gold when the dollar goes up. So with this said, let's look at the bonds. TBT, we're getting a new Twomey track line to be established. It's less aggressive, very less aggressive, and we are getting almost a cone effect, if you will. See how this is? I don't know if you can see it, but this line and this line is our new tracking line, and it's not flattening out just yet, but it does seem to be forming a point. And usually, what that starts to tell us, see, we had this very aggressive red line going up, and now the next track line is less aggressive. And in fact, it's starting to flatten out. And if it does go to a point here, at that point, if the cone narrows, it's telling us that it may either go flat for a while or turn down. Don't know if it's going to necessarily mean it's going to go up. So we have to watch that. But we are shorting the bonds. I added quite a bit Friday, told everybody to add to this is the 2 times shorting of bonds. It's everybody everything came down a little bit on Friday, but it was a good time to add to it. I wouldn't abandon this at all. I would stick with it. If TBF is the 1-to-1, same story there. If you didn't add, you want to start adding. Okay. Let's see. We looked at copper. Oh, energy. Ooh boy. Let's try XLE. XLE. The energy took a bath, right? See, it does, and according to this, usually when we get a doji type candle, it can act as like an indicator that things are going to continue the last direction, which is down. It's in the middle of our Twomey track line, so a little unpredictable. What is the relative strength index? 59 and dropping from 72. So it took the heat off of the overbought sector a little bit. We already talked about environment factors. Energy is, I added Thursday and Friday. So, if you haven't added it, watch it. If it's down, you probably have a good chance to keep adding. Whether it's XLE, some people do OIH. These are oil sector plays where OIH is really more the service side of it. XLE has energy, gas, and oil, and also the service providers. So it's a little bit bigger basket. OIH is an expensive price, and that fluctuates quite a bit. So be careful on that one. UNG, I've been adding to that as well. Our inflection point is still in a positive nature. And again, the cone here is, as you can tell, the steepness of the curve, right? We've talked about that before. We've got 3 of them that we kind of track. Actually, there's one. I took one away, actually. And there's one that was pretty steep, and now it's starting to flatten back out. Relative strength index, 54. It's abated a little bit from where it was. So we're in good shape there on the relative strength index. It's definitely coming down. But natural gas never should be going up in the summer, but it is. And that's because of all the environmental factors that are happening out there. So hopefully they'll continue. One of the things that I look at is advanced decline. I cleaned up this chart a little bit from last time that we looked at. This one might be better. This is from stockcharts.com. The top here is the relative strength index. We're very familiar with that. That's showing 44, so it's not overbought or oversold, right? The bottom is our MACD, and it is in positive territory, 1.86 and what have you on the upper MACD. So that's good. That's telling us things are going to be going the same direction. But if we look at our advanced decline here, the red and black, the busy chart here, red and black, red is down days and black is up days. So this is a daily chart of that. The blue line here, dark blue, is the 50-day average, and then the 200-day average is red. So advanced decline, if it stays above the 50-day for quite some time, that's kind of telling us the market is going to hopefully abate, and then we'll have a rally. But we haven't, I look at more the weekly. I didn't copy the weekly here, but to tell me that versus the daily, 3 or 4 days on the advanced decline doesn't tell me enough to convince myself. And here's the reason why. Look at everything above the 50 here was only, maybe a week. And then look how long we went, a month and a half, almost 2 months below the 50. Above the 50, the last bear market rally, 4 or 5 days maybe. And then now we're heading back down. and it's been below the 50 all the way from 2022. So that tells me the trend is down. It's continuing down. Yeah, we have some bear market rallies, but you really need to see this flatten out around that 50 in order for us to feel comfortable and over several weeks. And we're going to have plenty of time if this market rebounds. So hang in there. All right, so sector table. Let's see if we can pull. This is very small print, and I apologize for that. But the sector table, we've talked about this before. We've got the year to date is what we look at as, or this last 6 months. And there, what's in the green? Well, the only thing that in green on the year to date was energy, plus 42%. No surprise there. 6 months is plus 44. The only other one is materials. It's plus 0.3. Not a heck of a buzz. And if we look at the last 5 days, everything's in the red, less so for energy. And if we look at the 20-day, energy's been positive, consumer communication services, consumer discretionary, healthcare, and utilities. What I am showing you this really right now is whenever we talk about XLU or utilities, materials like copper or gold, and healthcare, those are our defensive sectors, and and consumer discretionary kind of crept up there. Well, we've got Verizon, that's communication services. Let's look inside of communication service. Interactive media, year to date, minus 25. Diversified telecommunication, minus 0.1. Wireless telecoms, minus 0.5. Media, minus 19. Entertainment, minus 30. So what is that telling us? Things like Verizon, wireless mobile telephones, people tend, that's what that's really saying. It's saying people aren't going to give up their mobile telecommunications or whatnot, or probably their cable. They'll cut back on cable selection, but people still need wireless in their home. So that's why we get into the Verizon, because it could be AT&T, it could be whatever, but I chose Verizon because it was at trading 9 times earnings, which is very low. Then it can go lower for them, and I'd like to see it go lower. But also, when it drops, it has a heck of a dividend. So no surprise there. Energy, we don't really. There's only 2 categories here. We don't have oil and gas and energy. No surprise there. Consumer discretionary. This is interesting. Automobiles minus 21. Internet and direct marketing minus 31. That kind of goes against our, buying internet and keeping it in your house, right? And Verizon and wireless. So there's a little bit deeper interpretation of that. Auto components minus 25. We're looking at the last 6 months, right? If you look, the best of all that was probably diversified consumer services. But it has popped up, and it's popped up in the last 20 days. The biggest is the internet and direct marketing and auto components, as well as diversified consumer. It's hanging in there. So we do have consumer discretionary play. I don't know if we're still in it 100%. Healthcare, of course, that is a defensive play. Healthcare technology is and life sciences tools and services. Providers, I'm surprised, minus 1.3. That's interesting. I would think that would be higher. Utilities is gas utilities is the biggest in the last 20 days. Water, lower end of it, independent power services. So it's like our CPG. Okay, so utilities and energy still are the top gatherers. But as we saw Friday, so the last 5 days got impacted by everything being sold off. Even our defensive sectors took a beating, but they're still in the top 5: energy, consumer discretionary, communications, healthcare, utilities. So that's we'll keep an eye on that, but we're our long positions. If they're going to survive any of this downtrend, it's because we're using our sector table to tell us what are our things that are good, not only in our overall trend, right? The last 6 months to a year, but also, or year to date, pardon me, but also, environmental and macroeconomic factors. How's our sector table fitting into that? So it's giving us some of our decisions. All right. So with that said, I think you've got a good game plan based on this analysis, and we'll go over our stocks later this week. Any questions, you feel free to email me. If you have inquiries on a particular stock, I can give you some insights on if you're in it or need to get out of it or what have you. Input on previous segments, topics you like covered. Hit subscribe so that when you log in or you look into YouTube, you'll get an alert. That'll give us the most recent trades that we're publicizing, or if there's some major market alert that you want to be aware of. So that's why the subscribe button's there. And if you like what you see, hey, terrific. Hit that like button. And certainly tell your pals out there that this may be something worth taking a look at. Previous segments go into the weeds on the Twomey investment process and how do we get there? How do we use our technical indicators as guide rails in our trading? And you can see we definitely did go back and we used those guardrails. We also did some interpretation on those guardrails. If you look at the SPY, we saw the bear market rally. We saw our third indicator kick off and say, hey, buy all in. And it went 1, 2, 3, 4, 5 days. And we're very nervous about that taking off on us and then we missing it. But we held back. We didn't even nibble, which turned out to be the right decision, short term anyways. And in fact, we did go against our guide rails and said go short before the CPI index come out there. So that was a little bit of an interpretive call, and I think it was a good one. The whole idea about that third indicator, and it can be nerve-wracking sometimes because we don't buy at the bottom, we don't sell at the top, and that feels like you left money on the table. But we're talking about trading. We're not talking about long-term. And when we get to that point when there's long-term, I do have great solutions for that. We'll go over that. And most of it's mutual funds. That's where it's that kind of buy and hold mentality, your 401k. I don't mean buy and hold forever, but I mean it's certainly the ways that can help you guide that. And that's how I really kind of got into this when I was working before I decided not to work. And then I had my own company for many, many years. I would help people, especially with their 401ks. And I would, they'd say, geez, Jim, I know you kind of watch the market. What would you do? So I'm not saying I'm right 100% of the time, but I want to pass that along. But we're not in that stage right now. Right now, we're trading. And some of our trades are going to work out, some are not. We certainly saw that 42% on CPG and the energy and that sector trade. We had some others that we lost 4 or 5%. But, and then we had one where we kept our trade. We took even, it's our first third and second third, we took off a little bit because we we got 7% profit and a 4% profit, and we still kept the third because volatility in this market, especially when you go long, you run the risk of losing. And right now we're into it. I'm not too concerned about shorting the market. We're going to have ups and downs. We're really going 1x there. We're not going 2x. But the energy, it's really difficult because if you go heavy and the bonds, shorting the bonds, I'm not worried about that. But if energy, we're in energy, I'm in energy, and I'm in it big. And I'm climbing the wall of worry there because I know I can wake up and it could be 10% done, and you get that panic feel. And our guardrails start flashing, sell, and then the next day it goes up a few percent. Next thing you know, you not only got the 10% back, but then it's way up. Energy is a rough sector to trade. The volatility is really high. It can hurt your wallet and it can hurt it fast. So we have to be careful there. If you're not comfortable, just take nibbles at small positions, and it is what it is. And I've done that in the past a lot of times. And I look back in the rearview mirror and I said, "Wow, if I put a big chunk of change in there, I'd be up 30%." Well, it is what it is. It is a rocky ride with energy, and you know. It flies against all logic. I mean, whoever natural gas. I mean, I can remember people used to laugh at natural gas, and I got into it at the December and January timeframe, and I hung in there because the market kept going up. I mean, and then sure enough, all the deck was laid and the cards were played, and then the war and everything else. That's why I'm saying there's no solution on the table right now. There isn't. There isn't any workable solution to bring oil and fossil fuels down. I mean, I don't know how 2.5 years ago, I mean, pre-COVID, it was two something a gallon or whatever. It was under three anyways, right? And then COVID, I could understand, but I was paying $1.40 a gallon, during COVID because it was the demand. That's the supply demand, right? We had too much of it. And then after COVID, everybody's, driving the price up because the demand's there. Yeah, it should go from 140 back to 240, but not to 5, right? So okay, the war, yeah, that causes some issues, but we were a net exporter of natural gas. We were independent of Russia and the Middle East and everything else in Saudi. We had plenty of, reserves, and now we don't. I don't see that changing unless there's a major change in philosophy, and that has to be not only with energy companies, because they have leases, but that doesn't mean they're going to get permits with all the environmental laws that have been now recalibrated. But I'm leaving politics aside. There isn't a quick fix, is what I'm trying to tell you. So there'll be fluctuations up and down, but I think overall we're gonna get up there. Are we gonna be in a recession? Technically, maybe not this next quarter, but in theory, most people feel like they're in a recession, and that means their pocketbook is getting hurt. And when people's pocketbook gets hurt, eventually they'll pull in their horns. Right now, we're at full employment. There's not a lot of layoffs. Companies are starting to stop hiring. Mortgages have crept up. They're so high, and there's been a big, I think, week over week or month over. Oh boy, I wish I had this top of my head. There's been a 16% drop in applications for mortgage. Makes sense. I mean, home sales is down. All makes sense because interest rates climbed. You can't afford as much on the house. Houses were overpriced. There is no inventory, blah, blah, blah. That's all coming to a halt. And it's going to work its way into the system. And then once people stop buying houses, stop taking loans, that whole sector, they're going to lay people off. Lumber's come way down. That's telling you the cost of lumber. Part of that supply chain, part of that people are going back to work making lumber, if you will, but part of that is demand is waning. Once that all subsides, that catches up, companies are going to start cutting back on their hiring. Then they're going to cut back on the staff that they have. And when that hits, that's when the recession accelerates. So am I hoping that happens? No. Is it going to happen? I have no idea. I'm not in the prediction business. I just look at the facts that come in here. We're also, there's a lot of factors going on and I'm kind of rambling here, but the dollar is now back on its huge increase. There's things that are happening that typically don't happen in a recession. Part of that is the war, part of it is supply chain, but part of that is there's macro issues going on between countries, and that has not fully played out. We're going to see how this all settles. And I'm just hoping we can keep full employment, because if we do, that's going to abate a lot of this, right? What does that mean? If people have jobs, even if gas kind of goes up and it hovers around 5.50 a gallon, higher in other states, obviously, due to other factors. But if people are working, they'll pay it. They'll cut back in other areas, hospitality, entertainment, and, cut back in their vacations. But if you have a job, you'll put gas in your tank. And you'll buy. If you don't have a job, then that's when things get hairy. So I'm hoping that we keep employment high, unemployment down, and that abates. That's the only salvation that I see that will create a soft landing. The Fed's not going to create a soft landing. The Fed's way behind. They missed this. I know selling off, they're running off their balance sheet of those bonds they bought. They feel that's going to be just like raising interest, and I agree. The dollar being up gives me some hope, because even though we can't buy as much, the dollar is not worth as much during inflation. We're not crushing our dollar, and that's a good thing. That's a good thing. All right, more on that this week. I'm going to focus more on trading the next several releases that I have out there, and watch those longs that we have. Keep your stops tight. You got to give yourself a little bit of room on copper, a little bit of room on CPG, and if you went long in XLE or OIH or UNG, you got to give yourself some room. You want the bonds, TBT, TBF, you want to nibble at that. You wake up and it's down less than where it closed the day before, you nibble. So if you got $100, you want to break that into flights of 10 over the several weeks coming. That's fine. If you have you want to be real aggressive, you want to take short positions in the next couple of days on short the small caps. You either do RWM, or if you want to be really aggressive and go 2x, you do TWM. And then you want to add to your shorts. With that, this is James Twomey. This is the Stock Market Report. Have a great Sunday.